there's been some crazy stuff that's been circulating about how interest rates don't work. And we even saw it on First Lien HELOC site. They're saying, oh, it doesn't matter if the interest rates go up. How can we do that with a higher interest rate? All because of the way we do the finance. Well, none of that's true.
In many cases, the First Lien HELOC position often does not make sense, especially in a situation like what he just gave. Velocity banking allows for liquidity where you're able to leverage the bank's money first before your own. It is a more efficient way to borrow money.
I don't know how that's much different. In other words, if I can't save the difference in my mortgage, how am I going to save the difference in my HELOC?
Welcome to BetterWealth. This is The Exchange, and on today, we are going to talk about velocity banking, first lien HELOCs. Is it a good idea? Is it not? What does the math say? And for this exchange, we have the one and only Denzel Rodriguez, the whiteboard geek, the person that loves numbers and math and loves to make videos about velocity banking, helping people pay off debt. You're also a big fan of life insurance and just an amazing friend. So Denzel, thank you so much for being here. On the other side is Todd Langford, the founder of Truth Concepts. He has a series with me where we dive into all of his amazing calculator. And gentlemen, I'm really, really grateful that you both were willing to have this discussion. The way that we're going to do this is I'm going to give you both 10-ish minutes to break down the philosophy so that the audience can really seek first to understand, like, okay, velocity banking, how does someone like Denzel talk about it? What's the case study? You both are going to use numbers. And then we'll have an opportunity to ask each other questions and go back and forth. And hopefully we'll agree to disagree on some areas. And maybe we might find that some of our ways of thinking might need to change. And so without further ado, Denzel, you're gonna start this thing off. Thank you, my friend. And anything you want to say before your 10 minutes start?
I'm just happy to be here. I love Todd. I've been a fan of him ever since I met him at the And Asset, the first one I went to. I've followed his material before. So if there's anyone I would highly respect that is on the outside of this particular strategy, velocity banking, outside looking in, he would be a person that I would like bring in to like poke holes everywhere, because he's got like just really awesome spreadsheets and videos where he breaks numbers down, and I'm like, ooh, I like that. Okay. And then I actually will incorporate some of his theories and thoughts into my strategies as well over the years. So I'm really excited from that standpoint. So what I would like to do today with my first 10 minutes to start this wonderful debate off, and hopefully we can get really into the thick of it, is really just share with you my rules around velocity banking, some simple numbers that we could look at, and some of the benefits that I think this strategy brings to the table that a lot of people are in need of, that they're looking for, that can help solve for sort of the primary financial goals that people have initially when they're working on their personal finances, that other traditional methods would not be as efficient, right? So right over here on the right-hand side, velocity banking, these are just main points that I want to highlight during this discussion, starting with the fact that I believe when using velocity banking properly and efficiently, it is a more efficient way to borrow money than the traditional methods out there, such as debt consolidation, taking out personal loans at high interest rates, locking yourself into longer term loans that have high rates and high payments sometimes, or even short loans with high payments, and even working with banks that often promote their loan products over their credit line products. Okay, so that's the first point I want to make, is that I think it's more efficient, a more efficient way to borrow. The second point that I think is huge is velocity banking allows for more liquidity in any financial strategy someone's looking to incorporate. And I would say if we're isolating velocity banking and the internet and social media and where people are trying to essentially pay off debt, they're trying to accelerate debt faster, the liquidity conversation sometimes goes out the door when you look at, say, debt snowball, debt avalanche, and maybe, just making extra payments, taking 100% of your cash flow and putting it toward a debt can present some of its own risk while getting out of debt. So velocity banking allows for liquidity where you're able to leverage the bank's money first before your own. So that's a huge point I'd like to make. The third is I have learned over the years that velocity banking can actually be used as a cash flow vehicle / a bridge in or before retirement. And a simple example of that would be someone that is maybe a few years out from retirement, and instead of maybe paying off their house or accelerating, or instead of withdrawing from an investment account, they could actually use debt to sort of buy some more time before they actually pull on some of their retirement levers, such as Social Security or an annuity or 401k accounts. So that's a very interesting move there that I've been learning more about, that I think has been very helpful in terms of in my space. I work with a lot of people that are 50s and up that are approaching retirement, and sometimes leveraging debt is actually more efficient than pulling from another vehicle when you compare the tax implication of it versus a 7% cost of money in a year, or 6 or 5, whatever the rate may be on that credit line. My next point is that velocity banking, I'd say 9 out of 10 times, is better than debt consolidation. And the 1 out of 10 I'm referring to where velocity banking doesn't make sense and debt consolidation does is when the individual has poor credit or high DTI and they can't even qualify for the specific tools that we'd be using for the strategy. Other than that, I'm constantly finding so many situations where people are consolidating debt with these national debt relief type companies where they hear on the radio, the internet, or an ad, and their credit gets tanked. They consolidate a bunch of debt into one location, and they may free up some cash flow, but they still have this massive debt, and they create a much higher cost over a long period of time compared to what the velocity banking could have done for them in smaller bites. So I have found it very, very beneficial to show them the difference. What would it look like to consolidate debt in a more efficient way in smaller bites using this strategy rather than one big move. Okay, and my last point is this is something I've just experienced personally over the last 7 years working with clients that have been 5 to 7 years out from retirement. Is it truly does help solve for retirement velocity banking strategy when people are able to accelerate debt much faster, especially if we're working with everyday average American, not so much entrepreneurs like Caleb, Todd, myself. I have noticed there is a difference in this world specifically whenever I work with certain business owners, that the retirement definition is vastly different compared to a mom and dad that's never ran a business before. They've worked at the same company for 20, 30, 40 years, and they have a deep, deep, deep desire to just completely be debt-free in retirement, right before retirement. And this is a phenomenal way for them to get them there in a much faster, more efficient way. And so with that, these are the points that I'd be making during this whole conversation. My rules for this strategy that I believe will help reduce the risk that this strategy brings to the table that other debt elimination strategies may not have, that I believe will create a balance here in terms of the risk to do this versus the reward and what can come with that. So I have some simple rules here that I've used that has made the strategy more efficient, because I'm only 29 years old. I first found this strategy when I was like 21, 22, and the way it was being taught versus the way I teach it today, really, really different. And I think it comes from a standpoint of me being more conservative than maybe some of the other content creators out there that might be a little more aggressive with this strategy. Granted, the more aggressive you are with this strategy can potentially yield more results. What I like to do is be super conservative and still yield very, very, good results compared to the simplest way of getting out of debt, making extra payments. So my rules broken down right here is I take an individual's cash flow times 12 in a year, and that just basically tells me how much money we potentially have to work with. If we're specifically focusing on an individual that says, I want to get out of debt, and that's my primary goal. I want to pay off debt as quickly as possible, free up cash flow, reduce expenses, reduce stress, et cetera, et cetera. And I use that as my measurement stick to determine if the strategy even is going to work for them or not. So cash flow times 12 in a year. I also look at the credit limit, right? With Velocity Banking, you need a tool. Those tools can be home equity lines of credits in the first or second position, a personal revolving line of credit, secured or unsecured, a business line of credit, secured or unsecured, and then credit cards, business or personal. These are your primary tools that the banks have where you can use this strategy efficiently. Anything outside of that is going to be an inefficient use of the strategy, okay? So whatever the credit line is, say for example, over here on the left-hand side of the board, we have a home equity line of credit, 75K. And so I would take that number, times it by 66% or 2/3, and just simply inform the client, hey, I don't want to leverage more than that number. And this develops what's called a chunk range to determine how much I'm actually going to leverage to eliminate some debt. So it's going to be between cash flow times 12 in a year and 2/3 of my credit line. The third component is using a credit card to run any bills that allow me to run that bill on a credit card without any fees or charges. And I'll actually receive a 2 to 3%, sometimes more, return on spend without changing anything in their finances, and that creates more cash flow on a monthly basis that can be used to actually pay down debt, which reduces their cost of money. The final resource I use is a strategy called Cash Flow Index. I learned this originally from Garrett Gunderson and then found out who the originator was, so that's really, really awesome strategy. Basically, I use Cash Flow Index to tell me what debts to pay off in which order to maximize cash flow as quickly as possible, okay? So I actually combine Cash Flow Index, Velocity Banking to help me decide when looking at someone's debts, when they line them all up for me, which ones we actually want to go at and essentially consolidate into the tool that we're using, HELOC, HELOC, business line of credit. Okay?
Denzel, I'm gonna help summarize because you're at 10 minutes, and so correct me if I'm wrong on any of these points. So instead of a traditional 30-year mortgage, someone could do Velocity Banking, and what you're saying is they, instead of having like a 30-year amortization tool, essentially, we're doing a first lien HELOC. I know that there's other personal lines, but I'll just use the first lien HELOC because that's probably the most favorable to this strategy from an interest rate standpoint and a collateral standpoint. You have access to that, and then what you're saying is you're able to put additional money in there, and then what you essentially will do is refinance, bad debt. That's more efficient to refinance. You have more liquidity through that, and then a lot of people, like, would you also say that paying off your house from a speed standpoint is like, it would be, this is the fastest way to do that if your goal was to pay off your mortgage as fast as possible? Like, do you think Velocity Banking gives you not only these flexibilities but also the ability to pay off your home faster than any other tool?
I would say, and this is very contrary to the biggest people in the Velocity Banking space, but I would say Velocity Banking by itself, trying to accelerate a mortgage within 5 to 7 years to try to go faster than any other debt elimination strategy, by itself may not yield the results that often gets promoted online. I would say if you were to combine velocity banking with making extra payments, then yes, every scenario I've ever
Yeah.
ran, I'm able to
Okay, so
like
you would say
accelerate.
that, and again, I'm not sure, Todd. I'm not. I'm just trying to put the packages up to before we transition, so that if anyone's watching this and saying I'm still confused about what velocity banking is, you would say if you accelerated your payments, though, there's no better way to pay off your mortgage if that was your goal. But there's also the reason you're a fan of velocity banking is it gives you a lot more flexibility to use that money for all kinds of things while you're also paying down your debts essentially. Is that Denzel? Am I articulating this well, or is there anything?
You are.
Okay.
I would say that you're giving the individual the opportunity while paying off debt, the liquidity factor that when life
Yep.
happens and things pop up, I'm gonna have a much higher chance of success than
Understood.
someone else in
And you
that
would
particular
say that
example.
that would be better. This would be better than the person that has a 30-year mortgage and just saves the difference in a high yield savings account.
To eliminate the mortgage?
Just in general, like you're going to have a better outcome with velocity banking than having a 30-year mortgage and putting this difference in cash flow into a high yield savings account.
Got it. I like what you're
So I'm
saying
asking
there.
you a question. I'm not, that's not a
I would.
statement that I'm standing by. I'm asking you that. Yeah.
Okay, yeah. So in that case, for that particular example, like I would prefer to have the liquidity and basically have my first lien HELOC be my savings account, be
Okay.
my.
So, but you get what I'm saying? Like, I think that's where it comes down to is this versus because you have to look at the alternative, the versus having a 30-year and saving the difference into a high yield savings account. So with that, I think I want to just commend you on out of all the people out there teaching this strategy. I do appreciate the conservative nature that you share, and I definitely want to just acknowledge, like anything, infinite banking or other things, like people can be really aggressive with how they share different strategies. And I think I've definitely seen from you try not to be like on the hype fest, but you're still a big fan of this tool and how it can help people as it relates to that. Hence why this conversation, we want to figure out what is the best way, what is most optimal. And one of the reasons I'm having the exchange is to exchange ideas, because it's through exchanging ideas where I believe it helps flesh out different scenarios and how we think. And so with that, Todd, I'm going to hand it over to you. You can set the stage if you'd like before you share your presentation. I know that you have a presentation for us, and I look forward to hearing your logic and your thought process on your view of velocity banking.
Thanks for having me here. I pulled some stuff off the first lien HELOC site, just going based on that and getting some of their numbers using their calculator. And so it's going to not talk about all the things that which we can discuss afterwards, but I just want to go through some of the numbers. And I really appreciate, Denzel, you being here, having the willingness, openness to be able to discuss it, look at the numbers, and Caleb for having us. And I think this is something that we need to get out there and boil down and just see what the numbers say behind what happens. And so in order to get through it as quickly as possible, I'm going to be speaking really fast. I'm going to try to run through it, and hopefully it'll still be understandable. So with that, we'll get started. Okay, so if we look at the first lien calculator, and again, these numbers that I pulled were kind of off their site on an example that they had. So $422,000 loan balance, 30 years. This is on somebody's primary mortgage that they currently have at 3.5%, and $400 PMI payment with a credit score of over 720. They currently have $15,000 of net income after taxes and $8,105 in expenses, not counting the mortgage payment. And what we can see up here on the right is it says that our monthly household cash flow is $68.95. They're talking about moving this to a first lien HELOC with a rate of 5%. And yeah, we know they're higher right now, but this was what was on their site. And $422,000 is the amount to be refinanced. So we're going to refinance the entire mortgage. And what it tells us, if we do that, we can pay it off in 5.83 years and save $195,000 in interest cost. They're showing a mortgage interest cost of $260,188 if we keep our 30-year mortgage. So first, let's just look at that and see if that's right. And here we have a mortgage loan amortization calculator, shows the 422 of current balance, 3.5% over 360 months. And yeah, it's the same $260,189 worth of cumulative interest over the time frame. So that is correct. Now let's look at the HELOC, and they're saying would drop it if we went to the 5% HELOC. We could pay it off in 5.83 years and have an interest cost of only $65,879. Now, how could we do that? 3.5% go into a 5% loan. But let's dig in and see, because we're always looking for some of those anomalies that might be out there. What they're saying is the way this happens is because your loan calculates interest, or how it calculates interest can affect how much interest you pay just as much as the interest rate or more. How HELOCs calculate their interest payments can save you tons of money in overall interest costs, because HELOCs calculate their interest differently. They generally use the average daily balance and sometimes the average monthly balance to calculate your payments. So what happens here, just in a nutshell, is rather than mortgage payment typically being at the end of the month and having the whole payment or the whole interest accrued during that month, somewhere between the end of the month and the beginning of the month is where the payment kind of happens and reduces the amount of interest that's being paid. I don't have the ability to do somewhere in the middle, and so with my calculator, we're going to look at this first and say a normal mortgage at the end. If we did the $422,000 at 5% over the 30 years, then what we see is the total interest charge would actually go up to $393,539. But what if I paid this at the beginning, which would actually be more impactful than that average daily monthly, but I paid it at the beginning of the month? What would happen is it would reduce it to $390,155, whereas it was $393,539. So it saves about $3,400 in overall interest charged, which really, you think in the big scheme of things of $393,000 is, pretty minuscule. So it really didn't make a big difference, even though they're saying that is the reason that this actually happened, was because of that daily interest calculation. So here, what I did was I said, well, let's take $68.95 on this mortgage over here, and look what happens when I do that. If I apply $68.95 to this mortgage, now we're getting really close to what they came up with, which was the $65,879 versus I've got $66,177. So I'm within $300, again, end of year versus in the middle. So basically that paying the mortgage interest costs across the middle made about a $300 difference in $65,000 over this time frame. So not really very much at all. Where did the $68.95 come from? This came from what we saw earlier, which was the difference between our income and our expenses, which they pointed out early during the calculator process. Okay, so this isn't really a fair comparison, because what we're looking at is $18.94 on our mortgage currently versus $68.95 on the 5% HELOC. So it should pay it off a lot faster with over 3 times as much money. If we put the same $68.95 towards our current mortgage, and not necessarily in it, but just in a tin can beside it. So we're still paying our $18.94 to the mortgage, but we're paying the difference of the extra $5,000 and just keeping it in a tin can over this time frame. What it shows is I'd end up with $1.8 million in my tin can checking account, whatever you want to call it, versus if I did the $68.95 on the HELOC, I would actually end up with more money, $1,994,000. So we've got about $194,000 over this time frame more if we go the HELOC route rather than staying with our traditional mortgage. And if we scroll down a little bit to month 71, when that pays off, what we see here is this is where we'd actually be able to start saving with the HELOC. Now, we've saved all along on the primary mortgage. And so at that point in time, we've got already $360,000 sitting in our checking account versus zero and starting from there. But still, the HELOC ends up across this time frame having more money. But that's because we're just talking about stacking it up with no earnings. Now, I don't know anybody that would have this kind of money sitting in a checking account and not be earning interest on it. So what would happen if we applied a 4.5% earnings rate to it? What we'd end up with is $3.8 million, $3,796,000 on our mortgage, and only $3,588,000 with the HELOC. And so there's actually $207,000 more if we keep our current mortgage and apply the $5,000 a year or a month, to a 4.5% net earnings account. If we could earn 6% instead, then we would actually be $567,000 ahead by keeping our mortgage. And if we could get the value of the tax savings, and I know we can, we get to deduct the interest on our primary mortgage. We can do that on our full mortgage. We can't really do that on our HELOC. We give some of that up, but assuming we could do it all, we can still see that actually moves us up even to $718,000, because with the HELOC paying the mortgage off faster, it actually reduces the interest that we can deduct. And yet, even with all of that, what we see is a cumulative interest of $260,000, just like we saw earlier, on the primary mortgage versus $66,000 if we go the route of the HELOC. So what happens is this interest charge cumulatively over time really has nothing to do with anything. It's stuck out there because it's a big number, and it's difficult for most people to see past that. But the reality is, what we need to be concerned about is the cash flow. Here we're putting in the same amount of money, $68.95 on one, $68.95 on the other. The fact that we paid more in interest to a particular account is really kind of irrelevant. What's really important is, did we get our house paid off in either of these scenarios, and which one did we ultimately end up with more money in our own pocket? And clearly that's keeping the mortgage at 3.5% and saving the difference. Okay. So off of their website, common myths and logical barriers to understanding this properly. It sounds a bit like a scam, so what's the secret? Essentially, all income and expenditures used from one sweep account. And so this is from First Lien HELOC's website, and that's exactly what's happening. They're dumping all that money in there, and that's why that extra $68.95 is being applied against that HELOC, and then ultimately, hopefully, being saved. Now, if it's sitting in the HELOC, it's not, but if we save it outside, we would have that differential. Okay, so this is just simply spending more money on the mortgage or the HELOC. So it's not what they talked about with the impact of the daily average interest and all that. That really had nothing to do with it. Again, $300 in the 70 months or so is all that impacted it. It's really just because we had more money going in. The next one was, how can I pay a higher interest rate on a loan but still pay less in total interest cost? Again, it's ignoring the impact of the time value of money. So there's cost for the fact that we put extra money into that mortgage that's actually not being calculated as having value, unless we do it the way we just did, which was applying it to both sides of the scorecard. What if interest rates rise? Why doesn't that really matter? It does if you calculate it properly. Like, as the interest rate goes up, the amount of money that's going to be paid off on that other mortgage is going to be much less. And we'll kind of look at that here in just a minute a little bit more. So here, couldn't you just pay the mortgage down faster? And this is one thing I think that gets a little confusing. So a mortgage is a one-way loan product. You can only pay into it, and therefore you have to keep separate bank accounts to maintain a personal liquidity to cover life expenses and living costs. But what if I don't put it in there at all? What if I keep it in a side fund in a place that I can have access to it? That could be, a high yield savings account. It could be a life insurance policy. It could be all kinds of other places. And then I wouldn't have any strings attached to it. And yes, you could argue that, at least under current conditions, that the HELOC has very little regulation. In other words, I have access to it. I can pay something down. I can pull it back out. But a lot of times that's for a limited time frame. And again, it's going to depend on whether house prices stay where they are, or house values. If that took a big drop, again, we still have to get permission, even with our HELOC, to be able to access those funds long term. Why does actual cost of funds matter more than annual percentage rate? Okay, so right down here we see a calculation, 155,332.36, which is the interest calculated based on a $300,000 loan at 3% for 30 years. And that is, I've run the numbers, that is the correct amount of interest. So taking that, dividing it by 300,000, which was the original principal, equal 51% actual cost of funds, also known as effective interest rate. Okay, so people read this and when they see something like this, they think, well, I thought I was paying 3%, and it's implied that, oh, maybe I'm actually paying 51%. Well, that's just because the math is totally meaningless and the formula is wrong here. This is really a huge mistake. If I look at this right here, effective annual interest rate formula, so this is the formula according to Investopedia, and you can see these ends up here. That's number of periods. We have to have time whenever we go beyond 1 year. So we're taking a calculation over 30 years and dividing it like it just happened in one day. That's where the 51% comes from. And it's really not a real number. But let's assume that it was for just a second. So what if I took $300,000 at 3% for 360 months? So I'm actually growing this money to $737,000 over this time frame. Well, 737,000 minus 300,000 that I put in up front means I earned an interest $437,053. If I use that same formula that we just had, 437,000 divided by 300,000, wow, I made 145%. So you could wrongly deduce that borrowing 100,000 at 3 to invest at 3 would yield a massive return, like, you know, a cost of 51% to get 145%. That'd be huge. But none of that's true. So let's look at it like this. Let's say I have a $300,000 loan at 3% for 360 months. I'm going to have to pay $1,264 a month at the end of the month to pay that off in that time frame. If I take the 300 and put it in an investment, earn in 3%, and I pull the $1,264.81 a month out of here to pay my loan, guess what? I end up with zero. And I think most of us knew that, right? If you earn 3%, if you have debt at 3% and you're earning 3%, you're not getting anywhere. It's just a wash, and we can see it right here. However, if I could borrow money at 3% to invest at 5%, I'd actually end up with $287,673. So why is there so much misinformation in the financial industry, which is supposed to be based in math? And these are the main reasons that I see in the industry. It's incorrect math formulas, it's paltering, and this may be new. It's actually a term that psychologists use, has been around for since only about the year 2000. It's really interesting. We all use this on a daily basis. And so here's just a quick definition of paltering. It's the active use of selective, truthful statements to mislead. And politicians use this all the time to dodge questions, but we use it as humans too. You know, a great example was somebody says, "Hey, how do you like my new outfit?" And it's something that you really don't like. Well, you don't want to be rude, right? And so you say something like, "Wow, you're really creative." Okay, well, they may be creative, but they're going to take that as you just answered their question and said you like their outfit, but you didn't say that and you don't like it. But that's what it led them to believe, right? And that's kind of the way paltering works. And what we see in financial industry is it's used to have numbers that really don't mean anything, like cumulative interest over time versus looking at what the real compounded value or cost is of making those decisions. The other thing is unequal cash flows when comparing optional outcomes, seeing two different amounts of money being compared and saying, hey, this one has a lot more money. Well, yeah, you put 3 times as much in there. That's not really apples to apples. And the last one that I see most often is excluding the effects of the time value of money. And this is a very difficult one because you can't do this with grade school math. And people try to use grade school math in finance. The only way you can really do that is to have time value of money calculators. And not everybody has one of those, on hand.
Wow, Todd, I appreciate you putting that together. Before I hand over to Denzel and we start a conversation, by the way, do you guys have a hard stop at the hour?
No.
Okay, great. Great, because I don't think we're getting anywhere in 10 minutes.
Hopefully that made sense. I make my 10 minutes.
Would be, out of all the things that you talked about, I again appreciate just how you broke this down with how you think. Is there a world where are there scenarios where a first lien HELOC, in your opinion, would make sense if you include the emotional aspect? I'll use Dave Ramsey as an example. Dave Ramsey will say things that I think all of us on this call would disagree. Okay, he would say things, but if we're giving him a break, he's also he's trying to be consistent because he's helping the people that have 30% interest on their credit card, and the moment you get Dave Ramsey tells them to justify debt, they're going to use that to, so it's like he's like saying like all debt is bad, and to the 50% of the population, that's 100% true. Like debt is the reason they're broke, so they need to listen to that. So it would be counterproductive for us to like try to attack him on all aspects. So my question to you would be, is there in your research and all, as you're diving into this, is there a world or scenario that you would be like, if someone had a 30-year mortgage, is there a world or scenario where you would be like, I can put the math aside a little bit and I could acknowledge that maybe someone wouldn't save the difference, and the first lien HELOC would be like that motivator to be able to fund? Like, is there any point that you would say, or is it very much of like, if someone gets this, they could do the same exact thing with a high yield savings account and actually have less risk because they're not on the hook for, not all their money's in a loan product. It's in a way it's safer. What is your thoughts on what I just asked? And is there like any way that you would say that refinancing first lien HELOC would make sense for a certain group of people?
Sure. And there's always a psychological aspect that you have to look at, and that's, to go to your point about Dave for just a minute. It's like his debt snowball is not mathematically better, but it might be psychologically better. And so it'll drive people to actually get it done, right? So there could be some good in that, even though it's not going to be the most efficient, but it's, for the cost of the difference, is not going to be that great. If somebody actually does it, that's way more efficient than somebody who has a plan of being more efficient and never does it, right? So that psychology can be a fit. But when we come to the house, I think that's a different scenario, because if you look at the HELOC, the whole point of the flexibility in the HELOC of being able to go in and pull money out means you've got the same problem of saving. If you're still spending money, because literally what you're doing is putting all your income in there and then borrowing money back to pay your expenses. So you're even in some ways adding a interest charge to your expenses, because otherwise, you could pay cash directly, but now you're actually, charging them. And so if you're pulling out more for your expenses, that's the same thing as spending on the other side. So I don't know how that's much different. In other words, if I can't save the difference in my mortgage, how am I going to save the difference in my HELOC? I'm going to spend the money there too. So I don't see where that would be of a big help. Like say for me, I would rather have the money outside. I'd rather have it free and clear from anybody, which would just mean, nobody gets to say. If I've got it in the HELOC, yes, we've got a lot of flexibility, and some of those locks are longer time frames now, but it still comes down to, will they let us have it? How does that fit against the value of our home or other things? And so for me personally, that's kind of the way I see that part of it. And I understand for a lot of people, this drive of having their house paid off, it's freedom, it's because they're afraid of what might happen and them lose their house. But think about, like in the illustration I went through, just put that money in a tin can. How much money we had in 7 years? We had $350,000. We could literally have paid off the mortgage at that point in time with money just sitting in a tin can. And so if one of those things I was concerned about, losing a job or having a temporary disability, I could reach into that other place and make my payments. That's much safer than either dumping it directly into the house. The HELOC would certainly be between those, but I think you still have a little bit more risk there than having the cash, personally.
Yep. Denzel, I'm going to toss it over to you. I want to get your initial reaction. Did you have questions? And then vice versa. I know Todd didn't necessarily address all the things that you spoke to. He had his presentation. I appreciate you both kind of setting the stage, and now this is where the exchange happens. And so I'll hand it over to you, Denzel, for statements, questions, and please poke holes and share your perspective.
Yeah, so that was really good, Todd. And the first piece of like real data I want to share here is this book right here. It's titled Own Your Home Years Sooner and Retire Debt-Free by a guy named Harj Gill, who is arguably the founder of quote unquote velocity banking. He would call it Speed Equity is his company. And this guy, being quote unquote like the originator, if we want to compare him to like a Nelson Nash that like came up with the term infinite banking or become your own banker, right? He was actually against first position home equity lines of credits for this particular strategy because of what Todd just explained. And I'll throw on top of that, in many cases, the first lien HELOC position often does not make sense, especially in a situation like what he just gave, where the person's got 15,000, I think, of income, cash flow, 6,000 plus, super low interest rate, 3.5%, moving it to 5. I don't think they even factored in the refinance cost of going to a first position HELOC. If you live in Florida, there's something called a stamp tax fee, something that you pay on every $1,000 of line of credit you get. So you get a $500,000 line of credit. In my case, I have a first position home equity line of credit on a purchase, not a refinance, but on a purchase. And I remember paying multiple thousands of dollars, I think, in just that one fee alone, along with all the other refinance costs that comes with getting a first position HELOC. So when you factor in that cost, throw that into the HELOC, it makes the numbers even worse long term. So from that point, like I'm actually leaning on Todd's side for that specific example. And I kind of hate it because I actually like First Savings Bank. I've referred clients to get first position home equity lines of credit there, but they don't actually go to that bank directly. They actually come to me first. We strategize and say, okay, let's look at them for this particular product to solve for these particular needs. Or if it was like a purchase instead of a 30-year. And what I've been seeing in this industry, in my world, is they're using that, how did Todd say it, that word, paltering? They're using...
That's a new word for me as well.
I know. They're using half-truth statements. It's true math, but it's irrelevant when you look at the grand scheme of things, especially if you compare paying off your mortgage or investing. In my opinion, I do think there's a segment of people, and I would put myself in this category, Todd, where you explain what you just said and it flies over their head. And what I've made a personal mission to try to like help is, what is the pregame work, or what is a pre-strategy to the strategy to get them to finally do what you would want them to do in that case? Hey, don't pay this off at all. Avoid all the emotional factors of not paying this off and do this instead, because you're going to end up with way more wealth, right? And so what I've done in my career the last 7 years is, instead of using the first lien HELOC position, where in some cases, like I actually do use it, I have one and I think it's very, very efficient compared to a 30-year when I was comparing the differences, especially on a purchase. Oftentimes I'm using a second position home equity line of credit, which is what this gentleman likes more. Often no closing costs, often a lesser rate than whatever debts we're paying off. And setting aside your example for just a second, that was looking at just mortgage to mortgage, right? Just that one thing. Mm-hmm. Where I would say in my coaching practice, I'm often dealing with someone that has the mortgage plus the student loans, car loans, credit cards, personal loans, that are often, all of these things outside of the mortgage are often higher interest rates than a second position home equity line of credit that I can find for them. And so now we're consolidating debt. We're paying off debt faster than just making extra payments, because I'm literally lowering their cost of money on a daily basis. I'm combining using credit cards to get cashback rewards. We have to factor that in. We get that return on spend with your money. And instead of doing a big bite, exactly what this guy was talking about, with the first lien is people like the bank is encouraging them, hey, consolidate all that, bring it to us, right? And we'll help you pay less money in interest. And it's a half truth. It's like it could and might not happen. Oh, if we were just comparing paying off debt to paying off debt, not paying off debt and investing, right? Because I actually lean with Todd on if I can get someone to believe and actually follow through with investing rather than paying off your mortgage, as a velocity banking expert, guru, coach online, I actually lean more toward that because the math will always outperform when you include investing, especially if you just simply use a cash value life insurance policy, which we all are on the same boat with using a properly structured whole life and just funneling the money in there before sending it directly into the property. And then when you factor in appreciation and then tax implications or reduction of tax liability by holding onto that mortgage, there's a lot of cool things there. So I kind of want to separate some things here. We've got investing instead of paying off your home. I often lean in that direction with some parameters, and I actually made a video about it where I give my parameters, how to go about doing that, or how you can consider go about doing that. If we put that to the side and just look at paying off debt versus paying off debt, what is the most efficient way to do that that doesn't include investing? Because of this segment of people that have no education on investing, they haven't put any time into it, and then you throw in the emotional factor and the indoctrination of Dave Ramsey and all his content creators that fall under that, which is pay off debt first before investing, right? They lean very, very heavily toward that. What would be the bridge to get them over to this camp? And I believe velocity banking is that bridge because it shows people how to use $1 more than once, how to reduce your cost of money if and when it makes sense, right?
Yep.
And ultimately prepares them, I think, for becoming your own banker, that whole strategy of funding a life insurance policy, of essentially earning money in a separate location that's safe, that's guaranteed growth, and continue to just make your mortgage payment. And then showing the math that here's the point where you'd borrow from here, pull from here, pay this mortgage off. So we're at least solving for the removal of the mortgage and then press forward, right?
So Denzel, I'm going to jump in here. It sounds like you're conceding to the fact that it's like, hey, I'm not saying that velocity banking replacing a 30-year mortgage is a great idea based on what Todd shared with the side account. But what you're saying is, and you can correct me if I'm wrong, because then I want to have Todd address that. So I think you're saying like, yeah, I'm not going to argue with the math there. You could always make the argument that emotionally this still could be better for somebody. Help them through the HELOC versus no help. I could also say that you could help them with a side account as well, as but that's a whole different conversation. But you're also saying is like you're still a fan of this concept of velocity banking, maybe not as a first lien, but as a second lien, which means if you have extra equity in your home, like you might be 10, 15, 20 years in, which I think the stats say most people aren't because they end up moving 7 years or so. But if they had extra equity, you could have a second lien HELOC. And if let's say that interest rate's at 7% and you have credit card debt at 20 or 30, or you have student loans maybe in 10 plus, that you could potentially use that second lien HELOC to pay off those higher debts, and like you are using now debt efficiently, and you were using money that wasn't having any utility to you because it was in your house that you wouldn't be able to access. Am I articulating what you said?
Yeah, that point. And I would also add that with a traditional 30-year mortgage, the reason why I don't have one personally, and I have a first lien HELOC on a purchase, often the refinance I'm not the biggest fan of unless I'm actually going from a higher rate to a lower rate. I'm like, that's a game changer oftentimes. And so there's this period in time, like during COVID and then like in the last year or two, where people have 6, 7%, 8% mortgages, and we were able to refinance into a first position HELOC, free up all that capital, don't have to have escrow, don't have to have homeowners insurance tied into an account. And when you factor in money that would have been sitting in an escrow, that you can actually just have that sit parked in your first lien. If I'm dealing with an entrepreneur, if I'm dealing with a commission type of person, commission, salary plus bonus, I'm giving them a location where they can just park money at times throughout the year more efficiently. The money, it costs less per day, and they still have all that liquidity. First lien HELOC is really awesome for that kind of person that goes up and down in income, but they're not necessarily trying to accelerate the property because they're like Todd, they're like you, they're like me, they want to invest. So it's like, park the money here, let it sit there, go down, use it again later. I don't know how to do the spreadsheets on that.
Technically,
But
to your point, if you wanted to do interest only on a first lien HELOC, that's possible, correct?
correct, on a first lien,
And so technically your payment to live
is significantly
interest only could be cheaper than a 30-year. And so you could potentially make the argument that investing in the difference. Todd, Denzel opened up a can of worms there at the end. I thought we were going to all agree but now but anyways, what did you have to say about second lien? And then what do you have to say? It sounds like, Denzel, you're like, hey, I get with the refinance, but you could still see an argument where first lien versus a 30-year makes sense for the points that you made. And Todd, we'll hand it over to you to share your thoughts and ask questions.
Yeah, it really comes down to the rate, and Denzel mentioned that. It's like, hey, you've got high rate credit cards, that kind of thing. If we can go to a HELOC that's got a lower rate and not be in a chunk to like pay it off and then have issues, just to find out, especially with a client that's gotten to a place that they have a lot of debt, they may have some control issues, right? And so before we lump them into a fixed rate on something else, that in between could be hugely beneficial. Dropping the rate and giving them some flexibility. Like, if I can't make the payment this time, well, I can borrow from the HELOC to make that payment. It gives me some flexibility, and I can see that as being a huge benefit as long as we understand that rate piece. And I know in the financial industry, there's been some crazy stuff that's been circulating about how interest rates don't work. And we even saw it on first lien HELOC site. They're saying, oh, it doesn't matter if the interest rates go up. How can we do that with a higher interest rate? All because of the way we do the finance. Well, none of that's true. It's going to make it more expensive, and the rate is what's critical. And so, Denzel, I really like what you're doing there from the standpoint of that second position. If we've got higher rates, let's move it to that lower rate, and a HELOC can be a place in between where until we completely get rid of it, now we're not paying as much. But let's see if we are actually disciplined enough to take that differential and do something with it, accelerate the payoff of the rest of that debt by having that extra money in there. So in other words, the same payment that we were paying on our other credit cards at a higher rate, we'll pay this down faster if we're committed to that. And so that's a good in-between test place too for the clients. And there's other things to start to manage that. Caleb, we've been exposed, and Denzel, I think at that meeting that we were at, the currents option is also a huge player, I think, in that area to start to collect some of that extra money and see what's happening, where are we spending dollars, let's apply that all in. And with that HELOC as a second position, wow, we've got huge flexibility and still be able to pay the debt off. The danger, of course, with any client is, oh, I got rid of my credit cards, let's go rack up some more. And so we have to be careful there, right? But there I can see some huge benefit. But we have to be careful to understand the rates absolutely matter. And some of the stuff that's gotten around is it doesn't. And that's really, if we're looking for pure efficiency. And obviously there's some places psychologically in between that we also have to address. But yeah, I think that could be a great place to do that kind of stuff as long as we don't go with the attitude that somehow paying higher rates is gonna because of the way they calculate interest is gonna get us ahead, and that's not true.
What's your thoughts on first lien, doing a first lien versus a 30-year? If your goal is not to pay off your debt fast, which most people, when it comes to velocity banking, like that's the pitch in itself, is like, hey, you can be debt free faster. I think we would all agree that that's not true. Like, you could figure out a way, especially if you add a modest rate of return in a side account to blow that out of the water. But what is your thoughts on the concept of, hey, I'm going to do a HELOC, first lien HELOC. I'm only going to pay interest only, and I'm going to have more money to potentially invest in a business, and I'm okay with my balance essentially being, full, like not paying principal. What are your thoughts on that? And then is there any what are your thoughts on that? If someone was like, I actually have more flexibility doing a first lien HELOC than a 30-year.
Okay, so what would have to happen there is your net returns would have to exceed whatever the cost of that interest was on the other side. So if I can get the HELOC at 7%, I have to net more than 7 in another investment to make that be a wash, right? At 7% net, it's just a wash. I'm paying the same interest here that I'm earning on the other side. So that would be the differentiation for me as to where that was. I think the risk with the HELOC at that point is we don't know if it's going up or not, right? Whereas with the mortgage, I could get a locked rate in. But people are changing houses out on a pretty regular basis. I think, what's the average now? I think it's gotten to where somebody stays in a house 7 years or something like that. So you're pretty much open to variable rates anyway, because every 7 years you're going to be whatever the market rate is at that point in time. And so having a fixed rate may not be that critical for somebody who is like, this is our house and we're going to stay here. I would think having a regular mortgage would probably have a lower rate than the HELOC, and it would get paid off versus having the risk of what the rates might do over time. And that's kind of, there's more to it than just the numbers, but the numbers are going to be whatever the rate is, and that is really going to dictate a lot. And as long as we understand where that is, then we can apply the psychological, the real world to it in our particular situation.
I asked our best friend ChatGPT while you were talking, and I said, I just took $1 million loan, and I said at a 5.5% 30-year mortgage, what would the payments be? And the payments would be $5,678.29. So let's just round up, $5,700. And then I said, what would the payments be on a 7% interest only? And it's $5,833. So I think in order for this to work, Denzel, for first lien, you would have, and originally I was like, if you only pay interest only, you're actually going to be saving a lot of money. In this scenario, you would actually, the payment is actually lower on a 30-year than just paying interest only at a 7%. And the 30-year locks in. So it's like, yeah, if I can totally see if I'm going to only be in a place for a few years and I could get a interest only mortgage or a first lien that's cheap, I could see the argument to say like, hey, I'm totally cool not having equity built up because I'm not going to be here long term. But in this scenario, it looks like the payments itself are a lot higher and you're not even paying off any of the principal.
Let me flip it. So I'll use myself as an example. Using a first position home equity line of credit as a purchase on a new home. When I was talking to different lenders, I had the option of getting like a 7 to 8% mortgage. Being self-employed business owner, I'm in South Florida. That was the rate that I was being presented with, 7, 8%. 30 year. This was 2023. Yeah,
okay.
This was 2023.
Okay.
Rates were really at its highest, right? Mm-hmm. 7 to 8%. Probably could have got something lower, maybe say 6.5, but like 7 is right where it was at with a couple different lenders. And you have the option of putting very little down on a 30-year mortgage, which I understand that piece. With the home equity line of credit on a first lien, you have to have at least 10% or more down to acquire the tool, right?
Yep.
And there are certain kinds of first lien HELOCs out there where you can get fixed rates for like 3 years, upwards of 5 years at pretty competitive interest rates. In my case, I locked in, I did a 4.99 for the first 6 months. And then the rate is fixed every 6 months it'll change to whatever the prime rate is. So I went from 4.99 closing of 2023. 2024 rates kept going up higher. And so my rate went to a 9.3 after the 4.99 6-month period ended. It went to 9.33. My particular strategy, the way that I operate, is I was just simply dumping all of this extra capital that I normally would keep in a checking account on the business and personal side and say, okay, I might as well just park my liquidity here. I have a desire to get a home, build a family, get married, all these things. And my primary residence is not necessarily going to be a cash flow vehicle, although I turned it into one by having this YouTube studio and doing all this work that I do at the house. So there is some benefit there. But we're talking me putting down this down payment. I don't have to have an escrow account. The homeowner's insurance and the property taxes can get paid directly out of the equity. All this money that I would have flowing in my business that would just be sitting in checking accounts for safety precautions could be sitting in the equity in my home, dramatically reducing that daily cost of interest. So even though I'd be at a higher rate, say this 9.3, now I'm at a 8.4, I think, because the rates have gone down. Compared to locking myself into that, say 6.5% mortgage with, let's just say I put the same amount down, I have to carry PMI at that point. If I put less than 20 with a first lien HELOC, I don't need to have PMI in that example there. So I just valued the amount of capital that I can just park in one place, and it's bringing down the cost of interest and the cost of money every single day. My payment is coming down every single day. At the beginning of any mortgage is where velocity banking is going to have its most value, I would argue. And then it becomes less and less valuable over time, which is where I educate my clients that you don't want to do velocity banking the whole way through on a second lien HELOC, right? Because if you're on a first lien HELOC, you got to do it all the way through because you already moved everything. You're already committed, right? So you got to go through with it.
But you could refinance. Like you could refinance if you wanted.
You could refinance out. You could get a different first lien HELOC at a low rate. You could try to play that game, but it is gonna, there's gonna be some costs and whatnot.
Yeah.
But in my case, I've got quite a few salary plus commission people who have fluctuating income where first lien HELOC is really awesome for them because they've got a place to just store all that capital. It's going to lower that cost of money. And then they still have liquidity. And if and when an opportunity presents itself, whether they want to buy another property or if they want to start a life insurance policy, start funding that, or if they need to buy a car, if they need to do roof repairs or whatever the case may be, you could argue that the cost to borrow within that first lien HELOC is way cheaper than most other loans that I would have to kind of lock myself into for the longevity of those payments, right? Now, again, that's just looking at pay off debt to pay off debt, like examples. I'm still conceding to the person that can articulate an investment strategy that doesn't have a whole lot of risk to it. I've got some parameters that I share with folks where I'm like, hey, there is no world where velocity banking will outperform an investment strategy. But velocity banking to debt snowball, making extra payments, like we can definitely have that debate there. And that's where it gets pretty interesting because then it can open up the conversation for investing in other opportunities.
I want to push this back over to Todd, and here's the question, Todd. Not assuming investing, but we're talking about debt. So say someone has 20% credit card debt, and they could have, I'll just use hypothetical examples that you gave, Denzel. They're going to purchase a home. They already decided on that home, so we're not talking them out of that house. And they could lock in their rate at 7%, 30-year mortgage, or they could do the thing that Denzel did and, let's just pick an average and they could have like a 8.2% first lien HELOC. It would be like my quick thought process without running the math would say I could pay off that high interest rate debt with a 30-year mortgage faster than the first lien HELOC. But I could be wrong. I want to just hear your thoughts and like, do you, and then not that Denzel asked, but I know his heart posture. Like, if you were coaching him as an entrepreneur who's got amazing opportunities and all, what kind of questions would you have asked him as he's trying to make this decision? And what do you think he should be doing, knowing his numbers now? Do you think Denzel would be better off refinancing in the future to a 30-year? Do you think he should wait till rates come down? Because right now rates are still somewhat high. Not investment advice. Just I want to hear from your thoughts on the situation that Denzel just broke down.
Yeah, I mean, the cost of refining, and that always depends, right, as to what's going on. Sometimes there's no cost refis that can be done. It just depends on where the banks are at the time. And so, you'd have to have a crystal ball to say, oh, no, don't do it now, wait, because I think, I can see they're going to go back down to 4 or 5. They may be as low as they're going to go, but they're still quite a bit lower than what Denzel's paying, on that 9.4 now, right, on the other side.
8.4.
Oh, it went to 8.4?
Yeah. So
at the top, it was at the highest at 9.33%.
Oh,
right
okay.
now it's at 8.4. And I looked at the time of this recording, 6.5 seems to be what you could get if we just, and again, this is just ChatGPT. 6.5 right now is what looks like you could refinance to if you have a decent credit.
Yeah, so I mean, like anything, there's always a cost for flexibility, right? If we're concerned that we're going to have that money, then paying a little bit more on interest to be able to know that we could pull it back, whereas our if we pay it against our mortgage, it's going to be the bank that's going to decide whether or not we can have it. And so, that's the trade-off of getting the better rate. Now, if everything was assumed, hey, we're going to have the money to pay it off, we're not going to need that money, then absolutely. The math says, refi it, go to the other section. I am curious about one thing that you said, Denzel, and that is you would suggest it up front, but not along the way. And I guess where I'm confused is the ratio of interest to principal is always the same throughout the length of the debt. Now, I know a lot of people, you hear this idea that we pay all the interest on a mortgage up front. Well, we pay more interest up front because we have more borrowed, not because the loan's constructed to do that. The loan's recalculated every time a loan payment's made as to, it's based on whatever the balance is at the time. So the ratios are always exactly the same. So the loan from day one all the way to the end, the rate is the rate. It doesn't change as far as the effectiveness or anything else at the beginning of one or at the end. So I missed something there on why you would do it at the beginning, but you wouldn't do it long term. Why it would make sense at the beginning, but not further along.
right. So on any 30-year fixed amortization schedule, we can agree that the amount of interest in the payment is more at the front end than it is on the back end. So if I get a client, they learn about velocity banking, they're like, oh my God, I want to do this. They have a 3% mortgage, but they've been paying on it for 12 years. And they try to get a home equity line of credit right now for 7% in the range. Right now, prime is 7.5%. So you're either going to be at a prime plus or prime minus around that number. I immediately tell them it's not going to make sense because you've already paid a lot of the interest that is on that particular loan. There's not much interest to be saved left because it's the form of payment on that 30-year note. Whatever the interest cost is what it is. You can only you can either cancel it out or just pay it over time, right? So I always tell clients like, no, that's not going to make sense. Now, if they were a brand new client that's got a 5 right now, a lot of my clients right now have between 5 and 6% mortgages, the ones that got them in the last 2 years or so. So between 5 and 6% brand new mortgage, yet you can find HELOCs right now at between 3 and 5% fixed for a period of time. All right. And then it'll go to like a variable rate. So there's like 3s, 4s, 5s, 6, they're all around across the United States. And I'm showing them that okay, look, we're going to do velocity banking at the front end of this mortgage, especially if we only have this mortgage. And they're like, Denzel, I want to pay this off. And I can't talk them out of doing anything else. They're like, I need to do this first. I've paid off everything else. All they have is a mortgage. Again, they lock themselves into this brand new payment. And if there's enough equity in there, we could get a small home equity line of credit, 30, 40K. It doesn't have to be a whole lot. Again, to this guy's point, and you do it in smaller bites, you're accelerating the principal forward and you're canceling the interest out in the beginning years. And then I inform them that we only want to do this for a period of time because eventually, just like the website says about the interest rate not mattering, like to me it matters. I know to you, Todd, it matters. There is scenarios where like being at this higher rate, but actually paying a lower effective cost of interest in a 6-month period or in a 3-month period or in a 9-12-month period, that number ends up being less depending on what I actually borrowed in that period of time. And then I applied it to the mortgage payment at the front end. It now my next payment changes, right? The amount of the percentage ratio of interest to principal now changes. Now my mortgage payment is more efficient than the person that is making extra payments on a monthly basis whenever they make that payment. And that's the argument that I present.
Because this is the precedent, like this is the whole pitch to this concept of velocity banking. Is that not, Denzel? Is like
Pretty much.
Especially front load of a 30-year, you're paying most of it to interest. If you can front load it in velocity banking, you're resetting all these things. I have a feeling the big word that Todd used in his presentation that started with the P potentially relates to what you just said, but I want to hear your thoughts, Todd, because I really there's anything that I can get accomplished in our conversation addressing that, because I think that is the conversation and so I want to just hand it over to you, Todd. If you want to ask a clarifying question, go ahead, but I want to make sure before we finish this conversation that gets addressed, because that is what I've heard from multiple people all over the place. Is it keeps going back to early on, the first 7 years, every 30-year mortgage, you're just getting ripped off because you're not able to accelerate that. And hence why something like a velocity banking could be valuable.
Yeah, that's unfortunate. That it's the wrong math. It's not on purpose. The ratio of the interest to the payment is totally irrelevant. The interest is based on the principal amount that's borrowed. And so it's the fact that there's more interest relative to the payment at the beginning doesn't mean we pay more interest. It's because we have more money borrowed, and that it's strictly on that. There's no difference anywhere in the mortgage. When you pick up that mortgage, there's no advantage outside of time to make that differential. Yeah, if I wait 10 years, then clearly and pay the same amount of money that I was going to pay today, well, paying it today would have had more impact on it than it would in 10 years. However,
Saying right there. Yeah.
yeah, but but we've got a different cost, and that's what's being left out. Paying it today costs me a lot more than it does paying it in 10 years.
Correct.
So that if we understand opportunity cost, not opportunity cost, see, opportunity, it's just opportunity. It's either negative opportunity or positive opportunity. It turns out a negative opportunity is an opportunity cost, right? But people use that word, but it's just everybody can understand opportunity. It's like, well, an example that I use sometimes. Let's say that I said, you know what, I'm going to give you $100,000 in the future, and you give me $10,000 a year for the next 10 years. How does that sound to you? Not good, right? That's terrible because I didn't earn any interest on that. Okay, so everybody understands value when we compound, when we have positive opportunity. It's hard for people to get their head around negative opportunity. And what happens is if I pay something today, it's going to have more impact on this loan. That's because it didn't cost me as much as paying it 10 years from now. But the impact, if we understand opportunity, is exactly the same wherever it is in the mortgage. So if it doesn't make sense 10 years out, it doesn't make sense today. from the standpoint of efficiency on the mortgage. Now, there may be other reasons because we need the cash more, or we have other pieces that fit in there. But as far as the efficiency of the mortgage itself, there's no difference if we understand the cost side, and that is where some of the problem is. Like with the first lien HELOC, is they try to make it all about the way they calculate interest. No, there's a huge additional cost. They're saying you've got to put an extra $5,000. That's 3 times as much money in there. Well, it should pay it off way faster if we're putting that much more money in there. But there's an opportunity on spending that extra $5,000 to make that happen, and we have to look at the alternative. And so the same thing happens there. So this idea that we pay all the interest up front on a mortgage is put up. It's just because we have more borrowed. It's
I
all a
understand that.
function on the amount borrowed, not on the payment.
Right. I'm in agreement with you with that. So on any mortgage, we understand that the rate is the rate throughout the life of the loan. But the way the payment, the form of payment, when you look at principal to interest, yes, more interest is being paid in the early years, and then that interest goes down, where then the amount of principal on your payment is now higher. And so all I'm doing with all my clients is accelerating the amount of principal of their mortgage payment to be more sooner rather than later, only when that person has a burning conviction that they want to get their home paid off as quickly as possible, without, say, taking risk to invest, right? Without doing that part. So again, whenever I'm dealing with people that are financially not there when it comes to investing, and I've been thinking about the bridge to get them there, I show them how to do velocity banking on pretty much everything else other than the mortgage. And then by the time we get to it, I show them math like what you do, where I'm like, sure, we can accelerate this home faster by applying more payments. How do you want to go about doing that? We could invest first and make a big lump sum payment later on. We could fund a life insurance policy, borrow from that, pay it off in one lump sum later on. We can make extra payments right now, 100% of your cash flow, or however much you want to apply to your cash flow each and every month. And if you just segment those two options right there, extra payments versus a home equity line of credit or some kind of debt tool to accelerate the timeline, more often than not, if I can especially get a equal rate or lower rate, whatever, compared to what the mortgage is, or slightly higher, not too high, right? I'm not one of those gurus that are like, it doesn't matter what the rate is. If it's a 12% rate to pay off a 3%, I'm like, I'm not there with that. I don't yield to that, because again, they're using that kind of half-truth math. But if the rate is close to what their mortgage is, and depending on where we're at on the amortization timeline, where it's like, if once you've already paid the interest, right, and now you've got 50% of your regular mortgage payment is going to principal, and the other 50% is going to interest, there's only so much interest left on that mortgage. Does that make sense? Like,
I think Denzel. Sorry, I'm not here.
Yeah, no. I hear what you're saying, and that's what it seems like, but that's not actually the way a loan works, because it's all recalculated every time. So maybe this will help. I know it's a difficult thing to get your head around, but so let's say I've got extra X amount of dollars. If I put that against a principal right now, we can see that as, man, this is having direct, you hear these things. Every extra dollar you put in goes straight to principal, and it's not eroded by interest or anything else, right? And that's the reason to do it on the front end, because we pay all this interest up front. But the reality is, if I didn't put it in there, and that money only earned as much as the mortgage was, and I put it in 10 years later,
it's the same effect.
I'm going to be at exactly the same place I would have been if I'd been putting it in for the whole 10 years. There's no difference.
We're in agreement there. Could you now look at it without investing? Like, if you're working with someone, because I don't know if you deal with this a lot, but I deal with this every day, where it's like the concept of investing, there's so much fear around, well, what if that doesn't work? And if you were just isolated to making extra payments versus doing a chunking style where you take a lump sum of money of debt and apply that to the principal of the mortgage and then pay back that lump sum by doing this velocity banking where you're dumping all your income in, taking expenses out, and you're playing a game of interest. Who pays less interest over the next 5 to 7 years? Like that's all we're playing. And we're trying to basically solve for who pays less interest when looking at a first lien versus a 30, or a 30 versus a second lien, or if someone has a 30 and a second lien and they're just kind of borrowing from here, putting in their mortgage, paying themselves back, and kind of like rinse and repeating. The only argument I make is I only want to do that at the beginning of the mortgage because it's not going to make sense for me to do it later on, especially if my rate is higher than the mortgage. That's the only thing that I make there.
Well, I mean, like I say, it comes down to the rate. Effectively, what I liked was when you were paying down the other more expensive debt, because when you pay debt, it's exactly the same as earning that in a return. So that's where part of the problem is. Like, if I have a 3% mortgage, if I prepay that debt, I'm basically only earning 3% on those dollars. That's it.
Correct.
On the other hand, if I can pay
not the 50%, number.
No,
right.
But the other side of it is if I can pay 18% against 18% credit card, that's the same thing as earning 18%. So doing it on that makes sense.
Okay.
But like say, a life insurance policy over time, you're looking at a minimum of 4% or so on the cash value there. That's not investing, that's saving, right? And I agree with you. Taking on risk instead, that's a whole different animal. But if we're in a place where we're not talking about risk, I want to look at the most effective use of those dollars. And I think what happens to people is they get hung up in this idea of I've got less risk by the more I have my house paid off. And I would argue that it's exactly the opposite of that. The more of my house I have paid off, the more risky I have. Because my bank's not going to, if things go south and I lose my job or something like that, the bank's not going to negotiate with me if I have a lot of equity. They're going to say, forget that. I can sell this thing at a fire sale and we can clear the books and I don't have to deal with you. Right? And so that's what's going to happen. The less equity I have in my home, the better off I am, with the ability that at any point in time, I could be at the same place. Like if it became more optimal for me to have that money in the house, I could just take my investment and plonk it into the house and it'd be the same place as if I'd been paying it in there all along, with the flexibility of having access to those dollars instead of having asked the banker to give them to me, in effect. Does that make sense?
Yes. We're in alignment, and I think what my side of the pond can learn from this is the whole idea of the length of time, right? The time value of money. When are we trying to make these different moves when accelerating debt versus the alternative? So you're injecting that opportunity cost or just opportunity of doing something else, right? And that's where I'm in alignment. I think the only thing that maybe we're in a disagreement in is specifically on the mortgage, because as it relates to any other debt, as long as the rate is higher than my line of credit, and even if it wasn't, I can show how even if my rate on my HELOC is 8%, but if I only owed whatever I owed on there for 6 months, I'm not paying 8% in full. Like it's 8% divided by what it shows, like a 0. Whatever the number is, here's your daily interest rate. And then that compounds up to a certain number. And my whole goal is basically I'm playing and reducing that net cost of interest. So if my rate was 8, but I ended up paying 4% technically in a 6-month period or a 12-month period, that's a better, say, return on spend, or that's a better rate of return when paying off debt or essentially consolidating debt from one place to another.
Here's what I said, Todd. If you want to address that quickly, but I'm going to suggest that Denzel almost creates a case study with numbers and either presents it and then maybe gives you time to take a look at it, Todd. Because I think one thing, Denzel, is time is the ultimate equalizer. And so it would be like taking what you're saying and looking at it and zooming out over 30 years and comparing it because we have to compare everything. I mean, a HELOC's great if you don't have a 30-year, if you don't have access to a traditional mortgage. It's like a HELOC or pay, like we're just in different categories. But if you have access to other things, like that's really what you have to compare to. And so that would be what I would suggest. Todd, is there anything else you want to say? Because I do want to wrap this up. I
Yeah.
do want to share couple takeaways that I've gotten from this discussion.
Okay. Well, just real quick, I think we have to be careful. The idea that, and it seems like this, but it's not. So, like an 8% mortgage that we only pay for 6 months, or a 8% loan cost, but we only pay it for 6 months and we pay it off, it's still an 8%. It's still an APR of 8%.
Correct. Yeah.
Okay.
Not
So it doesn't change it to 4%. It doesn't mean it costs us 4. It costs us 8.
8. Yes.
That is the cost. Even if we pay it off in 6 months, it's still an 8% APR is what it has to be compared against. And that's the reason it's interesting. That formula that was on their website that showed us the 50%, that formula, the actual effective annual interest rate formula, is designed, when it's done correctly, to normalize all interest rates so that you could compare what is a bi-monthly rate of this, how does that compare to a monthly rate of this to whatever else. It actually shows you what the real APR is, and that's what you have to judge the decisions on, not on the fact that I took an 8% loan and paid it off in 4 months or paid it ahead of time doesn't mean it didn't cost me the equivalent of 8%. It's just a shorter time frame.
Shorter time frame, lesser dollars actually spent, right? So if we were to say, okay, an 8% car loan here versus a 7% line of credit, we agree that's simple, that person's going to pay less at 7%. The argument is if we took an 8% car loan and stuck it in a 9% line of credit, or even an 8.1% line of credit, and you're saying any interest point above whatever that car loan rate is not going to make sense inside a line of credit. And that's where I would say, no, I can show how I'm actually going to end up paying less total interest, right? If I can just say the words properly, like if I have say a 9% line of credit versus an 8% car loan at the very beginning, you go with your 8% loan, make your extra payments. I go with my 9%. We got the same income, same cash flow, same everything. I'm going to end up paying less because of the amount of volume of money I'm applying up front compared to waiting to make those extra payments. Right? I'm saying I'm gonna get a head start. That's all I present.
I know what you're.
Okay. Yeah. Go ahead.
I know what you're saying. Unfortunately, that is the part that they were talking about when we went through there, and that is that idea of the daily average. It made $300 difference in $63,000. It's minuscule. It's not the amount of money that people think that it is.
But then we also have to factor in the different elements, like did they remove escrow at that time? Do they have PMI? Can we take PMI off sooner than the mortgage? And then are we running bills through a credit card to get those points and cash back? Because that does play a difference. And again, I'm in the camp that only does it for a period of time. It's like I'm in and out with it, and then say now secure the win. Like don't keep leveraging. Like you just do it once to essentially cancel out all the interest, a majority of the interest on that amortization loan, and you shifted it into your line of credit. Now pay less total dollars in interest in the line of credit, and you win. You now are paying off your debt faster, right?
Yeah,
not every time.
Yeah, but the issue is the opportunity is left out of that. When we look at cumulative
Correct.
interest,
I won't
we can't
lie.
measure
Yes.
that. That's not a real number. It's It's irrelevant because there's no opportunity on it. You would never, if you were growing something and they said, I'm going to let you just compile this, just add up, the $10,000 a year for the next 10 years, you wouldn't be happy with that. You would say, no, there's got to be opportunity on that. We've got to understand, I deserve an interest rate on that. Well, the same thing happens with the interest cost, that negative opportunity. And when we compare it, we take it over time and leave out the time value of money, the numbers aren't, unfortunately, at that point, aren't real numbers. And that's where part of the problem. And it's so confusing. It's so hard for people to understand because why? We come from grade school math teaches us everything is about today. 3 plus 2 is 5 today. 3 plus 2 over 30 years is a whole different story, right? And so we can't use grade school math to measure when we're talking about time. If we're talking about 1 year, that's maybe we can do some of that. But when we go over time, it's left out, and it looks like the lower cumulative interest makes a difference, and yet it doesn't. What we really need to do is step back and say, what do I end up with? Do I end up with more even if I paid more interest cumulatively? Yeah. I don't care how much interest the bank gets if I get more, right?
Yeah.
Right.
Guys, this
is good.
has been fascinating. I just want to thank you all for watching. Please comment down below, like, questions. Denzel, if we are going to have a part 2, it'd be awesome to see a case study, and maybe Todd could run some scenarios, truth concepts. I will say these, and Todd, I want your blessing on these two scenarios on where I think first lien HELOC potentially would make sense. Is scenario number 1 is if someone was set on paying off their house and was not interested in a side account. So it's like they either are going to have a 30-year mortgage and aggressively pay it off, or if you could convince them to do a first lien HELOC, they're aggressively paying it off, but there's you can't get that money back if an emergency happens and all. So there's an aspect of, I know you've talked about a side account, I would also be in favor of the side account, but if someone was not interested in that and they were just aggressively paying off their 30-year, I could see that I would be open to paying a little bit extra in interest to having that option, increasing my optionality. That's the one scenario. The other scenario is, at the time of this recording, if mortgage rates are at 6.5, a 30-year mortgage is at 6.5, and let's say I can get a first lien HELOC at 9, okay? There's no doubt that it's going to cost me more to do the first lien at 9. But if I was not into investing, I was not an entrepreneur, and I was going to have my other money sit at a checking account earning less than 1%, the way that I see this scenario is my opportunity cost is actually the 6.5% of the 30-year mortgage. And by me overpaying, I don't save the 9% because I need to compare it to what I could have done, 30-year mortgage. But I would say a 30-year mortgage, you're unable to have flexibility. So I would much rather, in that scenario, if the opportunity cost was keep their money at 0%, you could make the argument that putting that money in a first lien, even though we're rolling some dice, even though it is costing us a little bit for that, would be an equivalent to earning a 6% return if we had no use for that money outside of a checking account. Do you want to,
No.
are we aligned there? Is there any other reason? Because I'm with you. I don't think there's any route that I would go first lien HELOC if I want to pay off. And I don't think the math is on that side, but I do think there is a world where you could pay for flexibility. And that is an area, and that's where that tool could be a tool to look at. But is there anything that you would say addressing what I said, or anything you want to add or subtract?
Yeah, the one thing I would say is I think it's interesting for somehow, this idea that I'm not into investing, but I'm going to invest in my HELOC. I'm going to invest extra money. Why can you do it there and you couldn't do it in a life insurance policy or even a 401k for that matter, where, worst case scenario, I could liquidate that and pay whatever fees are in the 401k and have the money.
I think the guaranteed rate is locked in at 6.5% because that's what the 30-year. So that to answer your question, it almost feels like a guaranteed 6.5, whereas nothing else outside of insurance, which, knowing what we know about insurance, you could make the argument that that's going to get you an amazing value.
Yes.
But that would be the argument of why you would do something like that.
Yeah, but you were talking about 9%, right?
Yeah, but I was saying you can't. A lot of people will say in a first lien HELOC that they're earning 9% by paying that off aggressively. But the problem is they're not comparing it to what they could have in a 30-year.
Right.
So yeah, you are, but that's like,
yeah, you could say,
you have
hey,
to
we're making
what you
20%
could
because we're
get.
going to go to a 20% loan.
Yeah,
Right.
it's like, let's first lien HELOC at 20%. Good news. Every time you pay an extra dollar, you're saving 20% on your money.
Yeah, that didn't work.
But you get what I'm saying. Like,
Right.
that's where you have to compare it to
Yeah.
the best alternative.
Agreed.
And that's why I think it's impossible to look at any one strategy in a bubble, because again, overseas, if they don't have a 30-year or a 15-year mortgage and all they have, then it's like we have to deal with the tools that we've been given to deal with, and we should look through the lens of efficiency. I just wanted to get your thoughts on, like, is anything I was saying like alarming to you, or as it relates to like logic of like when you could justify a first lien HELOC with those assumptions?
Like I say, it depends on the situation. It always does, like you said. It depends on what other debt and other things they have. To me, I guess because the money's more tied up. You still have some risk with
I agree.
the home equity, but if you were worried about the investing side, you could always just do a shorter mortgage time, right? You could do a 15 and you'd be forced to do that. And I don't think that's a great answer, because that really messes up your options into the future.
Exactly.
And you have to have the ability to save on the other side. You just have to understand it's going to cost you to do that. It's not more efficient. And I think that's the main thing.
Agreed.
So going to a
Yep.
9% loan is going to cost you. Now, you may have some efficiency there, but I would say you'd have even more efficiency if you stuck it in your checking account and had no risk. Put it in a savings account at 2%.
Yeah.
Instead. That could be an option. It just depends on where rates are at the time.
You're if you choose a higher interest rate, there's a cost for optionality, and what you're saying is you would feel way safer having that money in a 2% savings in that scenario than a higher loan when the rules could change on both ends, but like they could lower the interest rate on your savings account, but they could also increase the interest rate on your first lien. Again, thank you so much for opening this discussion. I'm looking forward to hearing how this is received, and I'm hoping to do these discussions around infinite banking and some of the things that are said there. I'm hoping to do this around different other conversations where I'm lining up a conversation around 401ks versus not 401ks. And so I'm hoping to have conversations where people can dialogue, and you guys have done such an amazing job having this. And so thank you so much for making this dream of mine a reality, for being willing to come on.
Well, thank you. This was, we've got to get this stuff out there where people can make decisions and see how it works. So it's a great opportunity, and thanks, Denzel, for your side and being able to see what's going on, and your ability to present is fabulous. So thanks for doing this.
Yeah.
Denzel, any final words on your part?
Yeah, I'll just simply wrap up by saying that those of you that are, looking into this strategy of velocity banking, I think there's definitely a lot of smoke and mirrors. There's a lot of half truths. And if you can somewhat get past that and really look at the numbers itself, look at the rules, what I've presented here today, in my specific example, it's so interesting the way we feel safer, right? And again, it's really different personal preferences. But for me, I like the idea of more liquidity with my first lien HELOC as a purchase, that what I did, and then the fact that I can move and use that money for different opportunities in conjunction with actually paying the line down without even trying necessarily, because automatically money's going in and money's automatically coming out. So I do think there's more efficiency there. There was a lot that I learned in this conversation in terms of the amortization period, the time value of money, understanding that if you're someone that is going to invest and you're going to compare that to paying off debt, you're definitely going to yield better results there. And Todd did make a good point. He's like, well, if you're going to invest in your home, why not also invest in maybe something else that could yield a better result? And I think Todd and I need to make more content together. Maybe the three of us need to do more, because I do think there's that world of people, and I'm in that camp where it's like, it's so hard for that person even to just do a savings account where they're gonna do better by paying off their mortgage faster. There's so many of those people that if they can just get rid of that, their clarity, their emotional stress is way down, their clarity's up, their focus, they're able to like actually see what are the new opportunities. And if I can help them get it done in 5 to 7 years or less, how much time did I really lose compared to maybe a 10 or 12, 13-year payoff strategy? Just making either extra payments or doing something else where it might take a little longer, but would produce a better result on the investment side. So that's always had that, arguments back and forth with whether it's a client really like them struggling, not me arguing with them, but like them struggling, trying to make sense of that. And I found that velocity banking tends to be like this level playing field where it's like, by the time we actually get to the mortgage, so many of my clients end up not trying to accelerate it unless it actually mathematically makes sense from a retirement standpoint to remove key risk. And I think having Daniel on here to talk about that, that's a whole nother side of velocity banking, dealing with key risk in retirement.
What I would like, if we do a part 2, is to speak with the same numbers, because I think it's so easy to kind of like hypothetical back and forth, and it's like, let's look at the same math so that we can look at scenario 1, 2, and 3 and actually have numbers versus like, because I think we could for days talk in circles on both sides. So, gentlemen, thank you.